Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everybody for joining us. So today is episode 28 with Mike. And so far, there's a few people who are here for their first time. So if you're new here, our focus on this meetup is really how to get started as a syndicator. And before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. So we're just going to go ahead with a few quick introductions. So for those who haven't met me, my name is Marcelo Cazini. I'm here in Houston, Texas. My background is in IT and software development. I'm a local CCIM member here with all the CCIM designation trainings. I'm also a multifamily investor, and I own and operate my own commercial real estate. And I also done single family fix and flips before getting into commercial real estate.
Okay, I'm going to keep it short because we want to hear from Mike. I'm a real estate investor. I'm based out of Houston. I'm an architect, and we're currently doing syndication in Houston with Martin.
Thank you. And I'm an IT security consultant for over 25 years. Now we are multifamily syndicators, and we have around 800 units under management. We have 135. Let's move ahead.
All right. So with that, Mike, do you want to go ahead and introduce yourself?
Yeah, surely. Thank you. A big thank you to the hosts. It's an honor to be here. I don't do this much, but this one was easy. They sent me what the questions might look like, and I think I can answer some of them. But on a serious note, it's, you know, I've know many of you on the call. Some of you I've never met, and hopefully look forward to meeting you one day. And I just love the fact that the hosts are doing this sort of thing. I remember when I was first trying to get into multifamily, I was starving for groups like this and to find a mentor to show me how to do this so that I did not learn the hard way on my money and other people's money. And I was fortunate. I'll talk about that. But look, we realize everybody, you know, it's your evening, you know, probably dinner at the end of this, and I'll do all I can not to stand in the way of your bottle of wine or your hot meal or whatever happens after this. But so with that said, so I'm a Houstonian. I've lived all over the country. I worked for Silicon Valley companies my whole career. Grew up in a small town outside Houston. Got fortunate, got into Rice University. Decided I didn't want to go to medical school, but I wanted to work in medicine. So designed implantable medical devices and worked for Silicon Valley companies, like I said, most of my career. And, you know, just hated leaving it, but I just wanted to control my life. I was on a plane every week, and it was fascinating work, but, you know, at some point enough's enough. So I had been investing in real estate probably 35 years before I ran into multifamily. By the way, I started when I was 6 years old. But yeah, and each time, and I've invested in all kinds of single family and mortgages and commercial asset classes. You know, basic single family rentals, neighborhood development, office buildings, warehouse, strip centers, you know, retail strip centers, and I made some money, lost some money, had no idea what I was doing. You know, I would have to do a bunch of them, I figured, before I would really learn. And, you know, that's just not the way to operate. I mean, it's kind of like day trading in the stock market. I mean, you know, it's like going to Vegas. Maybe you're a winner for a short period, but over the long haul, you're not going to win. There's too many factors that you can't understand and you can't control. So I was looking for an asset class to be busy and active as I left my career, and something that would be intellectually stimulating and something that had a relatively low risk, and something I could leverage other people's time, experience, and capital. And multifamily just checked all the boxes for me. Joined Lifestyles in Houston, went to one meeting, figured out it wasn't for me, not a knock on Lifestyles, but I was focused strictly on multifamily. I had the great fortune of bumping into Brad Sumrock. Many of the folks here I see on the call here have been to a Sumrock event or are in the program. There's plenty of these programs around the country, and I can speak about that later. But so I invested a lot of capital, got an expert to teach me, and I dove in, had a lot of capital to deploy, was blessed, and and working for startups that either had IPOs or were acquired by larger companies. So most people think if you make make some, whatever your goal is, and that you're set, but you're not, because you have to have money to live on. Your money has to make money. And traditionally you would buy stocks and bonds, but that's just not the whole solution. It's not even close to the whole solution. And for those of you that have capital to deploy now, I would very much caution you against those two asset classes. Although I still have a lot of investments in those, in equities. I'm slowly pulling it back over the years. So that leads me up to today. I've been with the Sumrock organization 7 years. After a short while, Brad asked me to be a coach and mentor. He also has a real estate brokerage company in Texas. And we represent Sumrock buyers of multifamily properties in Texas. There are 4 agents, 2 in Dallas, 1 in the Hill Country, and then I'm in Southeast Texas, everything south of Dallas, over to the Louisiana border. I'm also a very active, passive investor. Again, I'm a coach mentor, and my number one sort of hat of the 4 multifamily hats I wear 7 days a week is to be a deal sponsor syndicator. I see here on the slides, it's a little bit dated. I took a look a couple of days ago. It looks like I'm headed to closing on my 59th multifamily deal in 6 states, and just 2 doors shy of 11,000 doors or 12,000. I need to know that. I should know that, but it's a lot of deals. Wow. A lot of them are passive, a lot of them are sold. Some of them are sponsors. I've gone full cycle, and I'm not sure, 9 or 10 deals as a sponsor. So I have a track record, and you have to live with your track record, and be happy to talk about that to anybody. But that's me, and this is all I do. I work out of my home, and I love it. I'm passionate about it. I won't work this hard for too many more years, but I want to be in multifamily for forever, because the underlying factor that you can't deny is the demand for affordable housing is only going up. There is no way it goes down. Now, are there places in the country where it might get solved? Of course, we see that in COVID in San Francisco, Seattle, New York, places that have strong rent control and basically landlord unfriendly places. We don't buy there. We don't look there. We can, buy properties a lot cheaper, make more return, a better return in other areas. We're buying in places that are in the way of the big demographic shift to the south. It's, the West Coasters are going to Arizona and Idaho, and the Midwesterners, Northeasterners going to Texas, all the way to Florida, through the Carolinas, Tennessee, Georgia, Alabama. So that's where we buy. That's where we look. Got strong relationships, all those markets, and we look for places with unique circumstances that make them particularly attractive to buy from multifamily. So that's an introduction. Sorry for the long-winded one, but
it's a delight.
So I guess it's a Q&A time.
It's a delight to listen to you. I can hear you talking, like I can stay here all night, Mike. So we have a lot of people here that they are at the stage 0. They want to be deal sponsors, they want to syndicate. What do you recommend to all these guys and the guys that just found out about multifamily?
Well, I think you need to educate yourself. There are resources online for free that will give you essentially an introduction and an overview. You'll hear differing opinions. If you want to seriously invest in this asset class, you need to understand it. It's easier to understand this than equities. Equities, there are too many factors, external factors that come along. You have no idea what's going on at the company level. You have no input, you have no say. You don't understand the business models, the threats and the competition and all those things. Here, it's more straightforward. And I'll just say that it's been a very, very well-performing asset class for many, many years. And again, I think it stays that way until there's some threat to demand for affordable housing. And I don't see how that happens. I think it only gets worse in terms of more affordable housing needed. We buy not new properties. That's our business model. We'll buy 1960s to say 2000 construction. And those typically are not bought by institutional investors, large REITs. Everybody know what a REIT is, real estate investment trust. We fly below their radar and we make a higher return. They buy newer properties, they're satisfied with a lower return, a little bit lower execution risk for those guys in some ways, but in other ways, it's not that much different. If you're in the new property business to new multifamily acquisition is your business plan. If you build a new apartment and fill it up, and some guy comes next door and builds a new apartment and steals your residence because they give away a lot of concessions, 3 months free rent or whatever, because they need to lease up. So it's a little bit like self-storage business. You know, you fill up, some corporation builds next door, and you struggle till the market absorbs. So what do? You educate yourself, read a lot. If you want a shortcut, join one of the educational programs. It's the fastest way to do this. If you're brilliant and read all the books, you'll be well ahead, but the actual hands-on practical knowledge you won't get by doing that. You won't have a group of hundreds of peers with best practices and shared best practices and a community of like-minded people. You won't get that if you don't get it in one of these groups. I would say get in a group that has all the ingredients to succeed. That is education, strength in numbers, strong reputation in the industry, and a pool of investors that enable the acquisitions and transactions to occur. I know that's kind of high level, but that is absolutely the thing to do. I never did that before multifamily. Had a spotty record and lost money, made a little money. It was not a strategy. It was a crapshoot. And I can't emphasize that enough. That don't try to do this on your own. It's too hard. It's too complex. But once you learn it, it's understandable. And it's something, again, it's not a black box. If you're going to be lazy and not learn it and you just want to invest, then go buy index equity funds and go sit on the beach and cross your fingers. Here, you can lay hands on the property. You can understand the business. You can talk to the syndicator deal sponsor as an investor. You can go visit the property. You can see monthly financials. It's a much more straightforward asset class. And in that regard, you have control, some level of control. Assuming you invest in a property in a good area with a good syndicator team, deal sponsor team.
Yeah, I think that's great, Mike. I was going to ask you I think you already answered it, with the now large amount of educators and mentors in the multifamily space. I think it's important for everyone to understand how to vet a good educator, a good mentor to follow. And I think you covered it perfectly with all those characteristics on the group that you should look for. So we have a question on the chat from Marcus. He's asking, would you mind sharing why, after being a part of a handful of successful startup companies, with a large amount of capital in earnings, why didn't you just retire to the beach and instead of getting into looking for and buying apartments?
Yeah, he's asking about, the other way to say that is, what's your why?
Yeah.
Why do you do this? Yeah, no, and I appreciate that. My wife's pretty straightforward. It's personal. It's not secret. It's personal, and everybody's got their own why. My why is God, the Lord, the Creator, and my family and children, grandchildren. I honestly believe that my grandchildren, their children, are not going to have the advantages I had, and maybe a lot of us have due to our age. I think it's going to get harder. I think the country is going to dumb down, and the entrepreneurial opportunities will diminish. Even though there's a few very thriving businesses out there, there are very few. So I want to give money to those causes, and help our family, and help others in the way that I believe, in a Christian way. And we all have our whys. And some people want a beach house, some people want a Ferrari, some people want to do this and that and go here and travel. And I've done all that, and I've been blessed enough to do it. But there's got to be more than that. So, I mean, that's why. I mean, I could go to the beach. I was at the beach all day today. Martin, I almost didn't make it back in time. But yeah, so
you can do multifamily and also go to the beach every day if you want.
Well, yeah, that's the thing about this. I mean, you can control your schedule. I mean, that's why I left my career, so I can control my schedule. If the phone rang and you got to be in London, tomorrow afternoon, I had to go. But now it's like, you want me to do what? How about Tuesday? And that's the way it is. And I'm fascinated by this. And it sounds squirrely, but I like helping people. I like helping people get in their first deals. I like sharing the mistakes I've made. And you can ask Martin and Claudia, I just pound them. Don't do this. Don't do that. Ask me why, because I did, and you don't want to repeat my mistakes. So, it's a challenging business. I mean, all business. If it wasn't challenging, everybody'd be doing it. There wouldn't be financially rewarding. So just follow best practices, read, learn, keep your eyes open. Don't be lazy. You'll do fine.
Right. Marcelo, you want to keep going?
Yeah, so Mike, there's a couple of questions from the chat here. One is, knowing what you know now, if you were 32 years old again, what would you have done differently in your 30s in relation to real estate?
Yeah, I would have invested in multifamily. I would have put every dollar I could into multifamily. It sounds pretty narrow, people diversify. Well, I mean, I spent a lot of time in single family, and you can do okay in single family. But let me just tell you, you got to have 100 rent homes to really begin to do reasonably well on an income basis, depending upon your goals. You don't have enough life force and energy, and then there's not a lot of return on your investment when you do that. You can buy one apartment complex or 100 rent homes, and the apartment complex, you deal with one person. You deal with a regional manager for the management company. You read reports, and it's so much easier, which you leverage other people's time and profession and skills. That's why I can be involved in so many properties and not just kill myself and drop every ball that comes along, because it's a well-worn path. And so yeah, I would have gotten seriously more involved in multifamily is the short answer. Now, it takes a little capital to get started. So, work hard, save some capital. Don't put it in your 401k, because it just that which is the American way, it doesn't work. It kind of works, but when you get there, what do you got? You're pulling money out, and you're paying all these taxes, and yeah, maybe you can do a Roth thing. you can do a self-directed retirement plan and invest in multifamily, that's great. It's not as tax advantage as using non-retirement funds, but I do that. I had a bunch of 401ks through all my startups. You know, you leave a company and you kind of have an orphan 401k. So I pulled them all together, set up a self-directed IRA. It was easy. And I invest in multifamily, and it's doubled in value in 6 years. And just, you know, I invest in a deal, the deal sells, I get the profit, I go invest in 2 deals. And then those sell, and I take that money, invest in 4 deals. And that's how it works. You build, ideally what you would do is build a ladder, a portfolio of investments. Let's say you're a passive investor and you've got capital deployed. So invest in a deal as often as you can, 1, 2, 3 a year, each year. And then you'll get cash flow from each of those, 8, 9, 10% typically. And then after 3, 4 years, the way we do it, typically we sell 3 to 5 years. And then you get a big capital gain on top of that. So when you're doing that, you get this nice cash flow from multiple properties, and then you get once or twice a year a capital gain pop. And you plow that back in, and there's ways to do it to tax advantage when you pay 0 income tax. I pay no taxes. I get stimulus checks. And I have negative adjusted gross income. You get a stimulus check based on your adjusted gross income. Mine are negative 6 figures every year. And it's not, I qualify as a real estate professional. You don't have to have a license. I happen to be licensed. If you or your spouse can qualify for a real estate license, you shouldn't be paying. And you have some capital to invest in these types of asset classes, you shouldn't be paying income taxes. So just leave it. That's a topic for a whole webinar, guys. The tax advantages of these, multifamily.
For sure. So Mike, one of the questions we got was, since you started, how have you seen the multifamily investment evolve, and what do you see as a new norm now in terms of changes in the multifamily space?
Yeah, while I'm doing that, Martin, can you pull up a CoStar report in the sales comps and, the cap rate, the 20-year cap rate curve? That would be one thing to show in the context of this answer. So what have I seen? I've seen property prices get obviously more expensive. I've seen untold sums of money flowing into this asset class, and accelerated by COVID, because all the guys in office, all the guys in retail, they're dying, right? I mean, there's a ground shift, and offices aren't going to be as occupied, and Jeff Bezos killed the retail business to a large extent, the brick and mortar business. So I've seen real estate investors, capital flowing towards multifamily away from those other things, and it's recognized it's a great return. It's a tax advantage return. I've seen, in the context of what we were talking about earlier, in terms of find a group, invest in your education, and learn about this stuff before you start deploying capital. I've seen I knew of 3 people when I first got in multifamily that had these education groups, 3 groups. Now they're everywhere. They're countless. You see people that I know, and I have to choose my words carefully, people that I know in their first deal, now they're gurus. They have these education groups. They're on the speaker circuit. They're on every podcast that, and I'm happy for them that they seem to be successful, but it's like, see one, do one. I'm an expert. I see it over and over and over. And, I don't know. I just figure out who, when you want to pick a group to join, to learn, pick the right group, talk to people. Oh, there it is. Look, this is a curve of cap rates. Just look at the red one, the blue one's Houston. So, it was almost 10% in 2000, turn of the century. Now they're down, close to 5%. So what does that mean? That means if you did nothing but own an apartment complex for 20 1 year's, it doubled. Of course, we know we're not going to hold it and do anything. We're going to improve it, going to raise rents, and increase the value of the property. See the bump in the middle? That's the '08 recession. That's the Great Recession. And, cap rates went up about 15, 18% temporarily, and then came back down, and then continue to go down. So that's what I've seen. If I could answer that question with a picture, which is 1,000 words, this is it. Capital is flowing to this asset class because the demand for affordable housing is only going up. You can't build a 1970s property that you can have $750 rents and make a profit. You can't do it. I mean, the cost of construction is outrageous. Cost of lumber is triple and quadrupled, since COVID started. So we're buying these assets, and yeah, they're old and they're not new and shiny. They don't have a, $1 million cappuccino bar in the leasing office, but we borrow millions of dollars. We improve them. We make them more safe. We operate them well. We create a sense of community, and we improve residents' lives. That's our goal. It's a feel-good business. But, we're capitalists. We're not altruistic. So, I don't want to sound shallow, but every property we buy and sell is a lot better condition across all those areas. And we're using great debt. The government enables unbelievable debt to be used in these deals. It's Fannie Mae, Freddie Mac. These are tremendous debts. That's why this business works so well. Part of the reason why 30-year amortization, non-recourse debt. You can get a supplemental loan. Right now, rates are hovering around 3%, maybe a little more. Last few days, they've crept up a little bit because of 10-year Treasury. But there's just a lot of reasons why this works, and there's a lot of reasons why all you guys on here, if you want to work hard enough, can do this. Everybody here's got a skill and a background to bring. I describe it as a three-legged stool. There's analytics. Everybody here probably knows Excel. If not, you can learn it easy for free online on YouTube. There's risk management, project management. A lot of people here at work, you've managed a project, maybe you've built something or, created a process or something, you can manage a project. And then there's good old human communication skills as the third leg of the stool. You gotta talk to people, you gotta understand what you're doing, because you need to raise capital as a syndicator. If you only want to be a passive investor, you really you should understand the analytics and read about the market and get to know who you invest with. Find out what their reason for being is, find out what their net worth is. If a property struggles, are they gonna send you an email? Hey, all investors, we're behind here. We need a couple $100,000. Everybody pitch in their share. Or is that deal sponsor gonna write the check themselves and cover and get the property back on its feet without doing an investor cash call? So what's your syndicator's track record? What have they done? What do they know? Talk to their investors. Hey, are they good? Do they communicate well? Are they responsive? How do they handle adversity? Because look, there's adversity all the time. Somebody trips in the parking lot, boom, you get sued. Pipes freeze, they bust, people get mad, boom. Power's out for 4 days. There's always adversity. So if you're on top of it, if you work hard, you'll come out fine. It's a risk mitigation.
We have a lot of questions from the audience.
Okay, I'll make them shorter.
No, we love to hear you. So, okay, let's do this one. What do you see that sets those who become successful syndicators apart from those who never make it?
So what separates the successful multifamily people from, I think it's work and focus, quite frankly. I think you need to be serious with yourself. Be honest with yourself. Are you going to devote the time? Or are you going to get frustrated because you've tried, and for example, as a syndicator, a would-be syndicator, I've tried and I can't find a deal and this doesn't work and it stinks and the world's unfair and nobody will help me. And I hear it all. And those are the people that are not focused and are not serious about this. Martin and Claudia, I mean, they worked so hard to get their first deal. They just tried and tried and tried, made so many offers, and then they got one, and now they got two, and then they're just getting started. Every time we see each other, hey, we're just getting started. And I go, yeah, I know you. I know you will. So I really think that that's a big part of it. Let me just add that if you have no capital to deploy, doesn't mean you can't succeed. It's going to make it harder. I'll just give you a brief example. I met a couple of guys that basically they lost all their money in a single family syndication. And, but you know, they kind of knew about real estate and they found a deal in a market I wanted to be in and got to know them. I spent time with them. I said, look, I'll bring everything. I'll bring the money. I'll bring, you know, my relationship with Fannie Mae, Freddie Mac. I'll you know, raise most of the capital because I want to be in that market. I'll show you how to do it. And since then we've gone on and done multiple deals. Now they have a little money. They started with nothing, but you know, that's not probably the best way to go about it. They were lucky. The planets aligned. They met someone who would help them and they were in a market that was desirable and they had a property that they could put under contract. So, you know, that's challenging, but possible. But if you're not going to work hard, just you know, be honest with yourself. But again, there's nothing wrong with being a passive investor. You know, I mean, when I grow up, that's what I'm going to be, right? So I have several friends who have made millions of dollars just in the time that I've been in multifamily by being passive investors. You know, they invest in good deals with good deal sponsors. They almost always more than double their money, 3-4 years. They take that money and they go invest in 2 more deals. And it you know, becomes geometric at that point. So when will it end? Who knows? What happened in 2008? You saw it. Things slowed down a little bit and then they kicked right back in gear. But if you understood that curve, so prices softened by about 15% or so for a couple of years. We always assume at sale, prices will soften about 15%. It's called a reversion cap rate. We assume a higher reversion cap rate than we actually buy the property at. So things have to degrade to the same extent they did in the worst recession in US history. And we have to sell at that exact wrong time. We still say you'll double your money in 5 years or close to it. That's how we underwrite. We're very conservative with a lot of, and I say we, those of us in the Summit Group. So, because that's how we were taught. I'm a coach and mentor, and that's what I tell everybody to do. And when they don't do that, I warn them. I say, look, I can't stop you. I think you're making a mistake. You're too aggressive, and you're risking other people's capital. It's very rare, though. Most people will get it right away. And most of our passive investors are wise enough to spot over-aggressive underwriting. So as a passive investor, you have to learn that. How to underwrite, at least to some level, or get someone to show you. Or the easiest way is to pay someone that knows how to evaluate deals for you. And they can teach you along the way. And you go, look, I've been presented this deal. What do you think? What do you like? What are you worried about? And then you decide yourself based on your own risk tolerance.
Yeah.
Sorry, that wasn't a short answer.
No worries. Clayton and Georgia have a question. They're raising their hand. Go ahead, Clayton.
Hey, Mike. Good. This is a kind of a good noob question for broker-seller interaction. You know, we've seen this trend of cap rate compression across asset classes, and obviously there's tons of competition in the marketplace, which, you know, drives seller behavior. But you know, I'm seeing a lot of older, you know, let's call them like C-class deals. You know, maybe they're in a 5 3/4 or 6 cap submarket, and the whisper price is like 4.7 cap. And so if you can't make the numbers work and, you just, everything you can do, you can't get there and you don't want to overpay, is your advice to go ahead and submit an LOI even though you're not going to be competitive, or to pass? In other words, how do you perceive that interaction from, you don't want to waste the broker's time, you don't want to upset the seller, but at the same time, you want to throw your name in the hat. So
Sure. No, I think that's a great question. Brokers like offers. Brokers want to look good. Hey, Mr. Seller, we ran our marketing campaign, we did tours. I've got 32 offers here. That's great. So they're happy to see your offer. Now, if you're the guy, though, that has made a dozen offers on a dozen properties that he's listed, and you're 15% below the whisper consistently, pretty soon he's not gonna get mad at you. He's just gonna come to the belief that, gee, this guy, he doesn't know what he's doing, or he's way too risk averse. We'll never get a transaction. You're not gonna make him mad. But I would say if you're within 10% or so, yeah, send the offer in. I would encourage you to, here's a self-serving a tip, but in all seriousness, if you've got access to a knowledgeable buyer broker, leverage that broker's relationship to communicate through that broker to the listing broker that, look, I've underwritten the deal. I've used, industry standard stuff. I'm not being overly conservative. I can't get to your number. I'm a little below. And, that's how you want to present it, instead of, gee, you're saying, I'm thinking, the world's coming to an end. I can only get a 2% rent increase. And we know that's not going to happen. If you cling to wrong ideas, then, you're just going to, over time, diminish your credibility. So if you're close, yeah, send the thing in and, get to know the brokers. But as a syndicator, don't start talking to brokers until you're ready. And you don't know if you're ready. Get somebody to tell you if you're ready or not. And try to, in those first touch points, get a formal introduction through someone who that they know. Like, hey, this is my friend Clayton. He's been underwriting deals a long time. He walks the walk, talks talk. He's going to be a serious syndicator. And, we want to come tour the property, come out and meet us, get to know us a little bit. I mean, that's kind of how you want to do it. You don't want to show up and start asking, gee, this property is, and according to my calculation, $6,315 per door, overpriced. That's I see that. I see people making a bad first impression. And as we know, you only get one opportunity to make a good first impression. You can overcome those things. It's going to take time. So hope that kind of answered what you were asking.
I did. Thank you.
Yeah. And apologies for my voice. We have a couple deals under contract. We had to raise $25 million in about 2.5 weeks, and I was on the phone for about 2.5 weeks. And I'm still recovering laryngitis here.
Some more questions. So Serby is asking, if the cap rates start going up now due to higher interest rates, wouldn't that be a headwind for multifamily?
That's a great question. If cap rates go up, what happens is your capital gain at sale is lower. So what we primarily focus on, we attempt to buy a property, is the cash flow. If the property cash flows, then eventually cap rates will go back down. We saw it in the worst economic shock in the history of the country, almost, other than the Great Depression. We saw it in 2008, and you saw it on the curve. What happened? If you had to sell in the middle of that, and you didn't do the conservative underwriting that I mentioned before, you might not have been able to sell, or you might have made a tiny profit, or, if you were really bad, maybe you sold and lost money, your investors' money. That's a disaster. But again, the economy goes through cycles, asset classes go through cycles. What's not going through a cycle is a demand for affordable housing. So eventually cap rates go back down, and the way to avoid getting sideswiped when you have those blips like in '08, you take long debt. You don't take 3-year, 5-year, 7-year loans. We take 10 or 12 year, and we almost always have enough runway to live through those. And when cap rates go back down, if you want to sell. If the property's cash flowing, you don't have to sell. You live on the cash flow. That's what we're doing here. You should have a ladder of cash flowing properties. But what happens is, the property, you increase the net operating income over time, property value goes up, and everybody wants a capital gain. Everybody wants to sell. I personally am going to start every now and then making one of my deals a long-term hold. Because there's a lot of investors ask that question. Hey, why can't you hang on longer? I want cash flow. I want steady, predictable cash flow. Because when you sell, I get a bunch of money, but then I got to go find another couple deals to invest in. So, so cap rates will go up and down, but they're not going to go up for long unless there is a miracle and somebody figures out how to house, tens of millions of people who quite frankly don't have the economic wherewithal to pay very much rent and certainly can't buy a house. My goodness, the '08 recession killed. I mean, how many people can qualify for a mortgage? It's unbelievable how challenging it is. It's easier for me to get a $30 million commercial loan than to get a single family mortgage or a HELOC, home equity loan. And that's not an exaggeration. So I've tried both. I've done both, but I feel for people trying to qualify. They've made it so hard. The pendulum swung way too far from liar loans. Everybody gets a house they can't afford to the other extreme. And, nobody can get a mortgage, or such a tiny percentage of people can qualify for a mortgage. So
I'm going to merge two questions we have here in the chat. Let's say for someone who's just starting out, what are the 3 things you would recommend when exploring a new market? And then what would you recommend as sources for research about the multifamily industry and trends?
Yeah, it's a great question. In terms of researching a new market, I think I really kind of mentioned the high level surrogates, the metrics that I look for, then one should look for. It's job growth, population growth, and landlord-friendly government, state or local government. Those 3 have to align. Then we look. That we don't look if we don't see those things. There's a variation on that, a corollary that I think that Phoenix, for example, checks all those boxes, but I won't go there because I can make the same return in Houston, Dallas, Jacksonville, Florida, Atlanta, Georgia, Birmingham, Alabama, name it, for a lot less invested capital. That is, cap rates are much lower there. Why buy in a cap rate? We try to buy in places with above average, national average cap rate. If you remember that curve, it was 2 colors. It was red for national and blue for Houston. And Houston's slightly higher, although it's converging, to the same. So, but it's not way lower, and which is what we look for. And by the way, what does that cap rate curve mean? That is a compilation of every property sale, multifamily property sale in every city of every age, brand new all the way to 50, 60-year-old properties. It's an average of all those sales, the cap rate of those sold properties. Okay, so that's what's representing. What it's saying is, there's money flowing in here, but there's also background inflation, right? I mean, look, if you buy a property and you don't do anything but run it, rates are going to go up of 2-3% a year, background inflation. Utilities are going to go up, salaries are going to go up. So that alone, the tide's always rising everybody's boat from that until you hit a recession. It's temporary and it comes back. So until we get no economic growth, that curve keeps going down, or until the demand for affordable housing for the 20th time I've said goes down, then that curve flattens out or goes up. How does that happen? I don't know. I don't see it.
Mhm.
It's not going to happen.
Yeah.
Yep. So on the first deal, Mike, what kind of property do you recommend people to focus on in terms of class B or C and number of units that you think somebody should focus on if
Yeah,
it's their first deal?
and this is as a syndicator, right? Not or
Yes, as a syndicator, yeah.
Yeah, so 60 doors to maybe 100, a little more. B or C, I don't care. The reason that kind of window there is that it's kind of a minimum purchase and thus a minimum amount of capital raised. About whatever the purchase price is, about you have to raise investor capital about 30% of the purchase price. $10 million deal, you raise about $3 million, and $3 million is 60 investors at $50,000. Do you know 60 people who would trust you with 50 grand? Maybe not if you're getting started, but the secret is you're not going to do it by yourself. You're going to find an experienced sponsor who's going to help raise that $3 million. And the other reason is that scale of property opens the door for you to hiring a professional third-party property management company that takes care of everything. There's no Sunday night calls when the toilet breaks, or the gate won't open, or my roof leaks. You don't hear any of that. Well, you do. You hear it on a weekly 1-hour call with a property manager, and you read about it in a monthly financial report. So there are professionals, a whole team of professionals between you and the property, and you pay them about 3% of your revenue to do that. And then you pay the salaries of their employees working at your property. There's typically one person in the leasing office and one person in doing outside maintenance per 100 doors, roughly. So if it's 200 door property, you have 4 employees, you're paying the salaries and you're paying the company 3% for doing the bookkeeping, the reporting, and for part of a regional manager's salary to oversee your property manager and your property. So I can oversee several properties by operating that way, and that's the way you should operate.
Yeah, makes sense. Now, Mike, just to recap what you said about choosing a market, you mentioned job growth, population growth, and the local government. So one of the questions was, do you think would you do deals in the Carolinas? Would the Carolinas fit that 3 criteria of yours?
100%. Been looking for a couple of years, don't have anything. And it's partially because I'm not focused enough and devoted enough time there. Part of it is, prices are high, cap rates are going down quickly all over. It's happening all over, some a little more than other places, as you see on the curve. And we look for places that, maybe are a little behind that trend, or maybe they have a unique feature like small town local government has banned apartment development. Okay, so guess what's going to happen there? Nobody's going to build new properties. So if you can get in that market, you're in pretty good shape, assuming population is growing. If population is not growing, or if it's diminishing, then I'm not buying there. If there's one employer that determines the whole thing, I might not buy there, with the one exception, and that is some university towns. I like some university towns. Solid universities grow over the years. Some do, some don't, but in towns where they do, I like it. I don't like student housing, so I don't want to be across the street from the campus. But, if I'm 5-10 minute drive, local economy depends on the university, and that's a great business model. Now, what happened in COVID? A lot of universities went virtual, and you had some exposure there. But if you were in an otherwise healthy city, we have a property in the university town, and we've raised the rents multiple times during COVID. At first, we had problems. We resolved them. Property stays relatively full. It's a big property, and so we like that model. But Carolinas, I love the Carolinas. I used to live in Atlanta, spent a lot of time there. I know the cities, and it's great place to live. A big chunk of the Northeast is moving to the Carolinas. Beautiful area.
Mike, I want to ask you, as a syndicator, what has been your biggest challenge? You know,
Violating the first 2 or 3 rules to live by in multifamily. And I did it with my first syndication. I picked the wrong partners for the wrong property in the wrong market.
wow.
And the wrong management company. Now, I didn't pick them. My partners picked all this. They picked me, and I go, well, great. You know, I've done a few passive deals. I want to be a deal sponsor. So I didn't get to know my partners. I didn't do the homework on the property location, and I didn't do the homework on the management company. I took their word for it.
Was
And
that your first one?
my very first syndication. Yep. And I'll just tell you, I put $900,000
Okay.
in the deal. Half that up front, because it was my first deal. I go, look, I'm raising money. I got almost $500,000 in the deal. I'm serious about this. So I had no problem raising capital, right? But then, you know, all those other factors started working against me, and a lot of external factors, fire, floods, you know, all kinds of things. I mean, a death by 1,000 blows kind of thing, just all the bad luck you could have on one property. And so then I had to come up with it, you know, over time, another $500,000 to avoid a cash call and to get the deal to the closing table to sell it. Got all investors their money back. They didn't make a positive return. They didn't lose money. And I risked all that capital to make that happen. So when you invest with somebody, I mean, I don't expect everybody could do that, but just make sure your syndicator doesn't have like $12,000 in the bank. And when the deal gets in trouble, you know, they're going to email blast and blow up your phone texting you, send in your cash call now, or we're in trouble. You know, you don't want that. So I'm not saying deals can't get in trouble, but why did I buy where I bought, where you know, flood risk? Why did I use that management company when I could have, you know, why did I pick those partners or let those partners pick me? It sounds like a lot of excuses, but it's all on me. I stepped up. So you have to deal with adversity. I mean, just like you guys had at Fairfield, you had some broken pipes. Boom, you were in there. Just like any other problem you've had, you take care of it. You do all you can to mitigate the risk. You insulate the pipes. You know, you can do the maintenance guy, do this, do that, but you know, stuff's going to happen. So, yeah. So that's we could do a whole webinar on that one deal. But I tell all my students, look, you know, you get number one, pick the right partners. Number two, pick the right property in the right location. Number three, pick the right management company. You know, don't buy in a crappy area. You don't want to be a slumlord. A lot of people make good money being a slumlord. You don't want to be, there's too many risks. Buy in a reasonable working class area. It may be a property you wouldn't want to live on yourself. You know, I mean, most of you probably live in much nicer houses than a lot of the apartments we buy, and there's nothing wrong with that. You want to provide it's safe, affordable housing, clean housing for people, and they will flock to your doors if you do that.
Yeah, so Mike, one question talking about underwriting, since you mentioned that as an important skill. Since a lot of these properties are now being recycled maybe 2 or 3 times from different syndication groups, what are you still seeing as meat on the bone in terms of opportunities for increasing revenue or maybe decreasing expenses?
Yeah, great question. So there's, you know, you can classify these properties in a million different ways. One is, you know, either it's what we call a yield play or a value play. A yield play is you're buying a property that's been fixed up. It's very nice. It's run very efficiently. You're going to buy it and just live off the cash flow because you can't really increase revenue that much because everything's been done already by the seller. Okay, and there's nothing wrong with yield play properties. The other kind of property is a value add. And the value add is either it's an execution value add or a capital value add. Execution value add is management company is terrible. The owner's an idiot. He's never been to the property in the last 3 years. There's trash everywhere, and just all kinds of crazy stuff. And the management company doesn't care because the owner's not beating them up. So that's all you have to do there in that deal. Bring in a good management company, and wow, things will improve. But the main thing we look for is capital value add. That is, property's old and tired. They've squeezed every dime out of it. They've put Band-Aid and chewing gum on repairs on everything for 15 years. And they're the lowest rent in town. And they collect that tenant profile. Okay, so you come along, you use Fannie or Freddie, you borrow 75% of the money to fix it up nicely. You make it safe, you make it clean, no roof leaks, beautiful paint, curb appeal. And you go and you start upgrading interiors and you raise rents because the quality of your interior now is as good as or better than your competitor. So you raise the rents on those upgraded units to match that of the competitors. And boom, your net operating income goes up, property value goes up, and you're happy. And if you can't curb your enthusiasm, you sell it and stick a bunch of money in your pocket and for the investors to do the same. Or, you can hold it and live off the wonderful cash flow. So as a syndicate, so I'm looking primarily, I don't look for yield plays, I look for value add plays. And I look for properties that haven't had all the interiors upgraded, for example. I want to be able to at least upgrade a third of them, maybe. And keep in mind, an upgrade is ephemeral. That is, it only lasts a little while. So you come in today, you resurface countertops, new appliances, new light fixture, new flooring or carpeting, you recoat the tub, the shower and tub, you paint the outside, place looks great. 5, 6, 7 years, it don't look so great. Those appliances you bought, they're looking kind of old school, and the countertops are kind of yuck, and the floors are scratched and dirty and can't clean them up. So if you hold it for a while, even your upgrades become meat on the bone, so to speak, for the next buyer, because your rents are falling behind the competitors who are continuing to improve their property, right? So it's a capital raise. I mean, you have to stay in the game. Take some money out of the property, refinance it every few years, or take a supplemental loan, give some to the investors, and put some capital back into the property if you're going to hold it a long time. Keep it looking good. Best in class, best rents. That's what you want. Or you can take the other approach is, I'm going to buy it and I'm going to run it in the ground until I have to sell it. I'm going to sell it and look at all the money I saved because I didn't put a dime of capital back into it. That is a business model, and it works for some people. I don't like it because you're shortchanging your renters. And when you talk to tenants in those properties, they're universally peed off at the world. And if they think you're the seller, they're ready to rip your lips off. And you go, no, I'm not, I don't own anything. I'm just here looking at this property. And I work for some rich guys that have all this money. So you never want to be an owner, at least while you're at the property. So I hope that makes sense.
Yeah,
for sure. Do you?
Yeah, we have a couple
Yeah.
last questions. That
How do you feel about secondary and tertiary markets?
Love them. Best returns ever in those markets for me.
Okay.
But execution risk. Can you find a good management company? Are you close enough to a major market that you can bring contractors in? Because you're not going to find a good contractor in these small towns because he's probably a deer hunter, and starting in November, you won't see him for 3 months. I mean, this is not an exaggeration. So finding good providers is difficult, including management companies. If you can't find a good management company, don't buy it. But there's also a bunch of reward there too. So.
Okay. And also, can you briefly explain how NOI affects the price of a property?
Sure, it's simple. It's a beautiful thing. Those of you know, everybody has a house, or most people have a house. The value of a house is determined by what the properties around you are selling for. It's called comps, sales comps. The value of an apartment complex, you're not buying a building. You're not buying bricks and sticks. You're buying a business. And the business is valued on the net operating income. That's, a crude way to say it's profit. Okay. It's all your rents and all the fees you collect, reserve parking, covered parking, laundry income, whatever. That's your income minus expenses. You got utilities, you got salaries, you got insurance, repairs, whatever. Okay. Property taxes. The difference between those is your net operating income. It's revenue minus expenses. Now, to value a property, you divide that by the market cap rate. What's the market cap rate? It's basically a number. It's a multiplier that people are willing to pay for that property of that age and that location in that city. Okay. And right now, okay, we saw how they were going down. Most markets, like let's call Houston, Dallas, 1980s property would be, maybe a 5 cap, maybe even a high 4. A 70s property is maybe a mid to upper 5. A 60s property is an upper 5. If I go to Phoenix, knock half or 3/4 of a cap rate point off. The other way to think about cap rates is, so here we go. 100-unit property, we increase rents $10. What does that do to the value of my property? And I'm doing mental math, and I'm going to embarrass myself. So $10 times 100 units is $1,000 a month times 12 months is $12,000 a year. If it's a 5 cap, I've just increased the value of my property $240,000, $250,000 by a $10 rent increase. That's the power of multifamily versus single family. That's it right there, that one formula. When I saw that, the light went on and I couldn't get enough of it, because I know if I work hard enough, I can improve. I can cut $1 out of expenses or add $1 to rent. Maybe the guy mowing the yard's overcharging me, or maybe the plumber that I have to call in is overcharging me, or I can go find a little bit cheaper insurance because I know an insurance guy. It's just all these things add up. And the other way to think about a cap rate is, think about these properties. You're buying an ATM and it spits out cash. Let's say spits out $100,000 a year. Every year, ka-ching, ka-ching. And you got to buy it though. And then you just go by there every now and then, get some dollars and go have fun. What would you pay for that? I don't know, Marcelo, what would you pay? I'd pay, let's say my bid is $1 million. Okay, so that means I'm getting 10% on my investment, like clockwork. But Marcelo said, heck, man, I'm not greedy. I'll pay $1.1 million. I love 9% return. And then the next guy may say, I'll pay $1 million too. I like whatever, 8%. So whatever people are willing to pay for that cash flow, that determines the cap rate. And people are going to pay more for properties that are newer, and people are going to pay more for locations that are growing with population growth and have higher median income, because I can charge higher rent because people can afford it. So all those things feed into what is a cap rate for a certain deal. You can't pick the cap rate. The market picks the cap rate. But the cap rate's your friend, as you can see, because it's steadily decreasing, although you do have interruptions.
Yes, absolutely. So Mike, we can keep you here all night, but we want to be respectful of your time here. So I do want to mention our YouTube channel for the folks who want to watch this presentation again. I posted the link on the chat, and also if you miss a meeting, then you can always watch our prior meetings in there and be notified when we upload something. And we always meet on the first and third Wednesday of every month. So the next meeting is going to be on March 17th. So the third Wednesday is always focusing on how to get started as a passive investor and how to get better as a passive investor. And then we'll be back again on the first Wednesday of April 7th, as another version for syndicators. And Mike, I want to thank you again. You have great knowledge. I'm sure everybody appreciated your time. So it was great meeting you here.
Oh, thank you so much. Thanks for the invite. And for those of you that really want to get into this business, just, follow Claudia and Martin and Marcelo and just read what they do, talk to them, call them, hang out, make Martin and Claudia take you to their property and show you around. And just, you got to be around people doing this, successful people. That's who you want to learn from, not people that can put a PowerPoint together and claim to be an expert and they've done 1 or 2 deals and have no other, get with people that know what they're doing. We're part of a bigger group of best practices people. And so that's how you get started. Spend time. If you don't have time or you're too lazy, again, go buy the index mutual fund and go to the beach and cross your fingers and fasten your seatbelt, because I promise you the roller coaster is just about to start. I don't know if it's this year or 5 years, but here it comes. So, and when the roller coaster starts, people will need, even more so will need affordable housing, right?
Right.
So,
Yeah, absolutely.
yeah.
Thank you very much, Mike.
Thank you, guys.
All right. Thank you.
Have a good evening.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.